Okay, we'll get started now. Welcome everybody. This is a webinar brought to you by Lucena Research. I'm Tucker Balch and I'm CTO for Lucena Research, and this is going to be about Lucena's proprietary hedge finding technology. And thanks for joining us. So before we get started, we have to cover a couple disclaimers. Um, First of all, Lucena Research is not an investment advisory service. We do not provide investment advice. The approaches we're going to show you here are not necessarily profitable. Do not assume that they are, and we're not soliciting you in any way. And finally, the results that we may show here are hypothetical, and again, don't assume that they're going to continue to work in the future. Lucena Research is a spin-off from Georgia Tech. It's co-founded by Erez Katz, who's our CEO, and myself, Tucker Balch. We're located actually on the Georgia Tech campus in Atlanta, Georgia, in one of the research buildings there that's cooperative with Synergy. I'm Tucker Balch. I'm an associate professor at Georgia Tech. I teach courses on artificial intelligence and finance at Georgia Tech. I've been a consultant for a #1 online broker, and I spent a year as a quant at a hedge fund. And I've really dived deep into this AI and finance and love it. I'm really happy to work with my company to bring you these products. I'm now CTO and co-founder of Lucena, and one of the inventors of these technologies that I'm going to be showing you. Okay, so here's what we're going to cover. We're targeting 40 minutes maximum. We might even get it done quicker. Going to show you our product QuantDesk, an overview of that. Then we'll dive into hedging and talk to you about our sort of special methodology for doing hedging, which I think is probably a lot different than what most of you might think of in terms of how we do it and the parameters and so on. We'll do a live demonstration using our QuantDesk technology, and please feel free to, as you think of them, add questions as we go along, and I'll look for those questions and aim to answer them as we get towards the end there. Okay, here's a quick overview of QuantDesk. QuantDesk is a web-based platform. When you run it, you can run it through your browser, and it's also available via Bloomberg, via the Bloomberg apps. We have released already 4 components of our product, and again, this is available on Bloomberg. The 4 that are out now are the a price forecaster, which uses machine learning to forecast future prices, a portfolio optimizer that uses mean variance optimization to help decide how to allocate among multiple assets, and the portfolio hedger that we're going to show you today. And finally, a backtester, which is very important, that allows you to test the performance of each of these components and see how they might work in a realistic scenario. And we'll look at the backtester for the portfolio hedger today. We have we've already completed some webinars for the forecaster and the optimizer, and those are available at our website. So if you want to go back and learn about those, go to the website and watch the videos. Coming out soon is an event analyzer, and we'll have a webinar towards the end of this month about the event analyzer. That's going to be a really exciting product. Now, what's hedging? Here's a quote from Investopedia. I'm sure you can find others online. But a hedge is an investment to reduce the risk of adverse price movement in an asset. Now, there's lots of ways that you might implement a hedge. Lots of folks use options. There's other sorts of derivatives you can use. You can also short stocks or short ETFs to produce a hedge. We have a little bit different approach, and we'll dig into it. But I think it's unique and interesting. That doesn't use derivatives, or doesn't require to short either. Now, hedging is a challenge, especially for most portfolio managers, because portfolio managers are, I guess, by nature optimistic. So we're good at finding equities we think are probably going to go up. And if you're looking for a hedge, you're often looking for something that's going to go down, so you can short it to counter your core position. It's hard to find stocks like that because they don't broadcast that they're in trouble. Another thing that makes creating a hedge complex or challenging is, for a hedge to be effective, it needs to be tuned to the particular portfolio. You can't, for instance, if you create a hedge just by, say, shorting S&P 500, you're not necessarily going to get the most effectiveness out of that because it's not tuned to your particular assets. There's 13,000 securities out there. If you're working with daily data, there's 250 trading days per year. That adds up to potentially billions of data points. That's really a challenge for a human to pore through. We can help with our machine learning based technologies, and this hedger is a machine learning based technology. So here's what our hedger does. I'm presenting it kind of in an academic kind of way. The problem for the hedger is, given a core portfolio, so these are assets you're holding, and you know, for instance, how many shares of each one you want to hold. We would like the problem for the hedger is to find a basket of new securities that, if you add to your portfolio, it'll reduce volatility and preserve return. So the hedger is actually finding additional securities to add to your portfolio, and they're tuned to your core portfolio. So each hedge, for a different portfolio is going to be different because it's tuned exactly to that portfolio. Our hedger uses stocks, ETFs, ADRs, mutual funds, essentially every security that's traded in North America. We don't use derivatives as of yet. Now, before I tell you exactly how it works, I need to tell you a little bit about a core technology that we take advantage of. This core technology, and I'll explain in a minute how that technology makes sense for hedging, but what this core technology is it's portfolio replication. So, for instance, if you give this portfolio replication algorithm the historical price performance of something, it could be an index, it could be a fund, it could be a specific security. The portfolio replicator can find a basket of equities that reproduces the performance of that price history. So as an example, we gave our portfolio replicator a problem. Now, we knew the answer to this problem, and one reason we ran this experiment is because we knew what the right answer was, and we wanted to see how well it could solve it. So we said, look, portfolio replicator, here is the performance of the Dow. So we just know the Dow Industrial Index performance over time, and that's represented over here by this red line. Now, it doesn't know what's in the Dow. It just knows what the performance of the index was. And we said, okay, we want you to reproduce that performance by selecting 30 stocks from the S&P 500. Now, again, it doesn't know what's in the Dow Industrials, and we're asking it essentially to find it. And this green line that you see here is the performance of the portfolio that it found with 30 equities. It nailed 28 of the components of the Dow. It missed on 2 of them. One of them, for instance, it chose Chevron instead of Exxon. So it was able to accurately reproduce the components of a portfolio that it didn't know what was in it beforehand. All it knew was the price performance. Okay. Now we simulate entering that those positions on this date. So in other words, it was able to look back from August 2011. Then it enters those positions here, and you can see afterward it tracks the Dow so accurately that you actually can't see the red line underneath it. So that's portfolio replication, and this technology we've filed a patent on. It's not a simple matter of anti-correlation. It's more complex than that, and actually uses a pattern matching technology proprietary to us. Okay, now how can you use this for hedging? Well, I'm going to step through that. Let's suppose this blue line here represents your core portfolio. It could be, a combination of stocks. And this blue line is the historical performance of your core portfolio, and you want to build a hedge for it. Here is how we go from that portfolio replication technology to build that hedge. So the first thing we do is we find a trend line. So from the beginning of its performance to the end, we'd draw a straight line through that. Now, if you think about it, if you want to hedge that performance, the ideal hedge is actually a mirror about that trend line. And that's shown right here with these green dots. So what we ask the system to do is find that portfolio. In other words, we want it now to replicate that dotted green line with a basket of equities. And if we add those equities to our portfolio, we have a perfect hedge. Now that, like I said, it's a proprietary pattern matching technology, and it's patent pending. We have a couple knobs you can turn on it if you want to, say, prioritize reducing volatility, which some folks want to do, or preserve return. You can get slightly different hedge baskets to serve those particular goals. Now here are some example uses of the hedger. This one is, for instance, looking at hedging the Dow. So we gave the system the following challenge. We gave it the performance of the Dow, and in fact, we're simulating that our core portfolio is the ETF DIA. And we asked, we rolled back time to 2009, and we asked the system, okay, look back, find the best hedge, enter that hedge, hold it for a month, and repeat. And so we trade monthly. We allow the hedge to be up to 40 positions. So the green line here represents the S&P 500 over that time. I'm sorry, it's the Dow Jones Industrial Index over that time, and the blue line is the hedged portfolio, including the core and the hedge. So as you can see, during upward times, the hedge portfolio performs well. It doesn't necessarily capture the full return, but in down markets, it's significantly less risky and less volatile. Across this time period, you can see that we increase Sharpe ratio from 0.63 up to 0.94. We reduce volatility, cut it just about in half, and drawdown is significantly less. Okay, so that's one application where you're seeking to preserve return and reduce volatility. Now another application is where you just want to reduce volatility in your holdings because you have an application where you believe in the future you know something about an event that will enable the stock, say, to go up or down. So here's a particular example. There's the core position here it's a single equity, is represented by this black line, and there's some event in the future represented by this red line. And let's say we have some insight that we believe when that event occurs, the price of the stock is going to go up. It might be, for instance, a drug stock, and we anticipate that the drug will be approved. It may be some other stock for which there's a legal case, and we anticipate that legal case to resolve positively for the company. Well, if you want to take advantage of that sort of situation, you'd like over time to be able to accrue a position in that equity without exposing yourself to much risk. So you could use our hedger on the minimum volatility setting to accrue position in that stock, and that's what this blue line represents. And as you can see, during that period, volatility was reduced. Compare the blue line to the black line. But then when the event occurs, you're still able to capture that alpha, and presumably after that you would exit the position. So that's another application for the hedger. Now some important features of our hedger that I think are worth mentioning. One, it doesn't have to be short only. So lots of folks think about a hedge as only being short positions. That doesn't work, for instance, in IRAs, or there's many investment situations where you can't short. So the hedge finder can actually find long positions to provide a hedge. It can also be a combination of long short, or it can be short only if that's what you want to do. It can represent a variable. It can represent a variable amount of your fund. For instance, let's suppose that you only want to allocate 25% of your total portfolio to the hedge. Well, the hedger can adapt to that, and the way it does that is it selects equities that have a higher beta compared to the core. Now, this is beta with relation to the core, not beta with relation to the market. But as an example, if you want to allocate, say, only 25% of your total portfolio to the hedge, that means in order for it to work well, your hedge has to be about 3 times more responsive than your core. So you need a beta, for instance, of 3 in order for that hedge to work well. So those are some of the features we've got. Okay, now let's do a demo. We're going to show you the product working live here, and let me fire that up. Again, this is available on Bloomberg, and it's also available via our cloud-based app here as well. Now, this is the QuantDesk application. Let me just give you a quick tour here. These tabs along the top select the major functions. Let's start with the portfolios tab. Here's a portfolio that's based on the 30 components of the Dow. And if you, for instance, wanted to edit it and add another equity, you can just by clicking Edit and Save. If you want to look, say, at a particular equity, you can click on it and see its historical performance there and technicals here. Now let's go ahead. So this example I'm going to show you is looking at the Dow. So we have actually just one equity here, which is the ETF DIA. So let's go to the Hedge tab and take a look how we can build a hedge for it. Now, all of our tabs are set up in the way that upper left here you select the group of equities you want to work with. In this case, we're working with this test Dow portfolio. Then over here on the left are a number of settings that you can use to configure the feature that you're going to use. So for the hedger, first thing you need to do is tell it, okay, which equities can it use to form the hedge. So in this case, we'll tell it, okay, you can use all of the Russell 3000. Do you want it to be long only, short only, or long and short? We'll select long and short. Now we've got 3 settings on sort of the goal for the hedge. Let me select minimum volatility first, just to show you what that looks like. Now normally with a minimum volatility hedge, we're looking to reduce as much as possible the daily volatility, and sometimes that comes at a cost of total return. You get the advantage of reduced volatility, of course, but also it costs you some return. And I'm going to show this in comparison to the preserve return method in just a moment. You can select the beta that you want to have the hedge to have against the core, and then how much of your portfolio do you want to allocate to the hedge? We're choosing 50% here. Okay, and let me start it running. So it's looking now at all potential. It's looking across all the Russell 3000, and it's considering all potential baskets of 40 stocks and finding the best one that, if you entered it 6 months ago, would provide you smoothest return over the last 6 months. So the result is shown graphically here and in a tabular form here. Let's look at the graph for a moment. So blue here is the performance of the core of the portfolio, the Dow ETF. The orange here is the performance of the core plus the hedge. Now you can see, of course, it's very smooth. Volatility is significantly reduced. Total return is reduced, though, also. You can look over here to sort of see a summary of that. So our volatility goes from 0.27% per day to 0.07, just 7 basis points. Now, one thing to keep in mind here, just to point out, is our original portfolio actually was half cash, so that we had some cash left over for the hedging. So the daily volatility actually is double this. So we're going from about 0.54 daily volatility, 54 basis points, down to just 7 basis points. Our Sharpe ratio increases. Our return is decreased, though, and that's a consequence of the minimum volatility setting. Now let's take a look at another one. Let's choose instead preserve return. So now we're going to prioritize. We're still going to build a hedge, but we're going to prioritize a hedge that also preserves return. We'll let that run. Okay, so now you can see actually the performance of the complete portfolio is actually better than the original portfolio. We've got a substantially increased Sharpe ratio. Volatility is well, it looks about the same, but in actuality, it's about half the original volatility, because remember, this original portfolio was half cash. We actually have higher return. Now, this is look back. In other words, we're looking back over this time. So yes, we should be able to discover a great hedge, given a good enough algorithm and enough time. The real challenge is stepping forward and seeing how it would work actually if we rolled back time and back tested it. So that's what we do with our back tester, and let me show you that. So we can back test each of our core factors here. We can backtest the forecaster, the optimizer, and today we're going to look at the hedger. And let's actually, I've completed a backtest already, so let me show you what that looks like. Oh, and by the way, if you run lots of backtests, we actually keep those results here, and you can go back and look at them as you go forward. But let me go to this one that I completed recently. Now let's look at these settings. So we our starting position was about 781,000. We rebalanced every month, once every month, and we selected a date range from October 2008 until the beginning of 2010. You can set any date range here you want. You can select a benchmark. Now our backtester also simulates trading costs. So for instance, when you enter a position, you usually affect the market in some way and it costs you. So we can simulate, for instance, 5 basis points cost to enter and exit. If it's a long short hedge, as this one is, when you borrow stocks to short, you have to pay interest there. So we have all these settings, including commissions. We can have a whitelist and a blacklist. I didn't mention the blacklist earlier. What that is you can add equities there that you definitely do not want to be part of your hedge. So, for instance, if your whitelist were ETFs, you might want to put on the blacklist the ultra leveraged ETFs if you don't want to use them. And down here are the settings for the hedger like we saw before. So we set all those, and then we can start the backtest. And since these backtests sometimes take some time, you can click Process in Background and let it run in the background, and you can check on it later. Let me show you here. You can see how it's running and come back and check on it later when it's finished. So I'm going to be like Martha Stewart. I've already got one in the oven. So let me show you the one out of the oven. So lots of people want to know, okay, how would this have worked through the down market in 2008, 2009. So in this case, the green line represents that core, the Dow, as if you were holding an ETF representing the Dow. And as you can see, we had that significant drawdown in the bottom around March 2009. Now, if we ask the system to find a hedge and re-hedge every month over this time, the net performance of the fund here is this orange line. The hedge actually performs very nicely. It's this red line up here. And we have some summary statistics up here. For instance, our strategy actually was up 2% over this time period, while compared to a benchmark, which was down 20%. We've got a positive Sharpe ratio and a significantly lower drawdown. Now, if you want to see more detail, we actually have a detailed report that you can click on down here. And this is modeled to some extent, after a fund summary sheet that you might see for, for mutual funds and so on, to summarize all the details of how this fund would have worked. So we have the summary statistics here. You can see the performance of the core, the hedge by itself, and the combined fund. There's actually positive alpha there compared to the benchmark. We summarize annual statistics, also long and short exposure, and we dive into details like correlation and beta of the fund to major indices. And just to scroll down here to the bottom, we also provide for each trading period the allocations and all of the transactions. So you can see if you had decided to use this method, what would have actually been traded. We account for commissions and slippage here as well. So those are the details you can get to validate things if you're running the hedger. I want to show one other use of the hedger that you might find interesting. Let's go over to Hedge. Sometimes you're in a situation where you just want to quickly find an ETF to use to hedge an individual security, and you can use our hedger in kind of a quick and dirty way to help you find the best ETFs. So in this case, suppose you're holding Bank of America, and you'd like to find a good ETF that you might use to hedge it. So we select the setting minimum volatility, and we allow it just to find 5 equities, and we're giving it all ETFs as the whitelist, and so we're going to see what it can come up with in terms of the best 5 ETFs that you might use to hedge Bank of America. So it comes up with an interesting list. Financial, so it wants to, for instance, short the Direxion Financial Bull shares. Let's say that you don't want to use these 3x ultra leveraged shares. You can just come over here and click remove, and it'll add that to the blacklist. So now, I don't know if you can see it, it's added FAS to the blacklist, and it's re-hedged. So now it's not using that that particular triple leveraged, and it's found another bank ETF that it recommends shorting. So this is a quick and dirty way that you can use to another way that you can use the hedger to find potential hedges. Okay. So that was our live demo. I'm taking a look now at some of the. I'll take a look at the questions here. So there's. I'll get to those in just a moment. But if you do have a question, go ahead and add them. Now, if you want to access the hedger, it's available on Bloomberg. Just type apps QH Go, and it's live on Bloomberg. It's also available via our website. Go to lucenaresearch.com and you can access it there. And yeah, let me answer a couple questions now. One question is, what big data technology are you using? We use a couple different machine learning techniques. Our database includes all the North American, all securities traded on the North American exchanges. Our backend actually uses combination of Python, MySQL, and C, and a number of instance-based machine learning technologies to wade through all of that data. Next question, in the hedging strategy, can we set limitations on the min and max percent for each security? So for the so the question is, for the hedging strategy and the optimizer, can you do this? So for the optimizer, you can set min and max. For the hedger, you can set a minimum. Presently, you can't set a maximum, but we very rarely see sort of over investment in any particular equity. Next question, how would the hedger work for a small amount? Will it work for a personal portfolio? Yes, absolutely. We see benefits sort of at very many scales. Can we use the application in other markets, not US? Currently, no, in the sense that our data is North American markets only. If you are interested in an international deployment, please contact us, because we can make a customized deployment for international markets. We'd be glad to do that with you. Is it possible to connect transactions to a real account and set the computer to make future transactions on the real market? That is in our pipeline. You should look for that probably in the last quarter of this year. But the answer is yes. We're going to add transaction capabilities very soon. Okay, I think we're running out of time now. Let me wrap it up. We'll address any additional questions and follow up. And let me say thank you very much for your time. And again, we are Lucena Research, and visit us at lucenaresearch.com. I'm Tucker Balch, and if you have any questions you want to ask me directly, just send them to tucker@lucenaresearch.com. Thanks very much for your time. We really appreciate it. All the best.